Hey there, ready to take control of your financial future? It all starts with some smart planning and savvy decisions. One of the coolest ways to grow your wealth over time is by diving into the world of investing. By putting your money to work in different places, you can score some impressive returns and hit those long-term financial goals. This guide will walk you through the basics of investment strategies, highlighting various options and what they bring to the table. Whether you're just starting out or have some experience, getting a grip on these ideas is key to making smart investment moves. Keep in mind, investing comes with its risks, so it's super important to have a solid plan in place. By spreading out your investments and getting some expert advice, you can lower those risks and boost your chances of success. So, let's jump into the world of investing and check out the different paths you can take to build a secure and thriving financial future. The investment landscape offers a wide array of options, each with its own characteristics, risks, and potential rewards. Before diving into specific strategies, it's essential to grasp the fundamental types of investments. One common way to categorize investments is based on asset class, which represents a group of investments with similar characteristics. The most well-known asset classes include stocks, bonds, and real estate. Stocks represent ownership shares in publicly traded companies. Investing in stocks offers the potential for high returns but also carries a higher level of risk. Bonds, on the other hand, are debt securities issued by governments or corporations. They typically offer more stable income than stocks but with lower potential for growth. Real estate investments involve purchasing tangible properties such as land, residential buildings, or commercial spaces. Real estate can provide rental income and potential appreciation in value over time. Understanding the distinctions between these asset classes is crucial for building a diversified investment portfolio that aligns with your risk tolerance and financial goals. Stocks, also known as equities, represent fractional ownership in publicly traded companies. When you buy a stock, you become a shareholder, entitled to a portion of the company's profits and assets. Investing in stocks can be an attractive option for long-term growth potential. As companies expand their operations and increase profitability, their stock prices tend to rise, generating capital gains for investors. Moreover, some companies distribute a portion of their profits to shareholders in the form of dividends. Dividends provide a regular stream of income, making stocks appealing to income-seeking investors. However, stock investments are not without risks. Stock prices can fluctuate significantly in the short term due to market sentiment, economic conditions, and company-specific factors. This volatility means that investors could experience losses if they need to sell their stocks during a market downturn. Despite the risks, stocks have historically outperformed other asset classes over the long term. The key is to invest in financially sound companies with solid growth prospects and hold your investments for an extended period to ride out market fluctuations. The stock market, where stocks are bought and sold, can be a volatile and unpredictable environment. Understanding the risks and rewards associated with stock investments is paramount for making informed decisions. One significant risk is market risk, which refers to the possibility of stock prices declining due to factors that affect the overall market, such as economic recessions or geopolitical events. Market risk is inherent to all stock investments and cannot be entirely eliminated. Another risk is company-specific risk, also known as unsystematic risk. This risk pertains to factors that affect a particular company, such as management changes, product failures, or increased competition. To mitigate these risks, investors can employ various strategies, including diversification, fundamental analysis, and long-term investing. Diversification involves spreading your investments across different stocks, sectors, and asset classes to reduce the impact of any single investment's performance. Fundamental analysis involves evaluating a company's financial health, management team, competitive advantage, and industry dynamics to determine its intrinsic value and growth potential. Long-term investing focuses on holding stocks for extended periods, allowing investors to benefit from compounding returns and ride out short-term market fluctuations. While stock market investing carries risks, it also offers the potential for substantial rewards. By understanding the risks, employing sound investment strategies, and seeking professional advice, investors can navigate the stock market and potentially achieve their financial goals. Section 5. Bonds, lending for fixed income. Bonds are debt securities that represent loans made by investors to governments or corporations. When you purchase a bond, you lend money to the issuer for a specified period, known as the maturity date. In return, the issuer agrees to make regular interest payments, known as coupon payments, and repay the principal amount at maturity. Bonds are generally considered less risky than stocks because they offer a fixed income stream and the return of principal at maturity. Government bonds, particularly those issued by developed countries, are often perceived as the safest investments due to the low risk of default. However, bond investments are not entirely risk-free. Interest rate risk is a significant factor affecting bond prices. When interest rates rise, the value of existing bonds tends to decline, as investors can purchase new bonds with higher yields. Credit risk, also known as default risk, is another consideration, particularly for corporate bonds. If the bond issuer experiences financial difficulties, they may default on their interest payments or principal repayment, leading to losses for investors. Despite these risks, bonds play a crucial role in a well-diversified investment portfolio. They provide a stable income stream, act as a hedge against stock market volatility, and preserve capital. Section 6. Real estate investing in tangible assets. Real estate investments involve purchasing tangible properties such as land, residential buildings, or commercial spaces. Unlike stocks and bonds, real estate represents physical assets that can provide both income and potential appreciation in value over time. One of the primary benefits of real estate investing is the potential for rental income. By renting out properties, investors can generate a steady stream of cash flow, making real estate an attractive option for income-seeking investors. Moreover, real estate values tend to appreciate over the long term, driven by factors such as population growth, urbanization, and inflation. This appreciation potential can lead to substantial capital gains for investors when they decide to sell their properties. However, real estate investments also come with their own set of risks. Property values can fluctuate due to factors such as economic downturns, changes in interest rates, and local market conditions. Additionally, real estate is considered an illiquid investment, meaning it can be challenging to sell quickly without incurring significant losses. Despite these risks, real estate remains a popular investment option, offering diversification benefits, potential tax advantages, and the psychological comfort of owning tangible assets. Section 7. Diversification, a key to managing risk. Diversification is a fundamental principle in investment management that involves spreading your investments across different asset classes, sectors, and geographies. The goal of diversification is to reduce the overall risk of your portfolio without sacrificing potential returns. The rationale behind diversification is that different asset classes tend to perform differently under various market conditions. For example, when stocks are performing poorly, bonds may provide stability to your portfolio, and vice versa. By diversifying your investments, you reduce the impact of any single investment's performance on your overall portfolio. If one investment performs poorly, others may perform well, mitigating potential losses. Diversification can be achieved through various methods, including investing in mutual funds or exchange-traded funds, ETFs, that track broad market indices, allocating assets across different asset classes, and investing in companies operating in different sectors and geographies. Remember that diversification does not eliminate all risks, but it is a crucial strategy for managing risk effectively and increasing the probability of achieving your long-term investment goals. Section 8. Seeking professional advice for personalized strategies. Navigating the complexities of the investment world can be challenging, especially for novice investors. Seeking professional advice from a qualified financial advisor can provide valuable insights and guidance tailored to your specific financial situation, goals, and risk tolerance. A financial advisor can help you develop a personalized investment plan, select appropriate investments, and monitor your portfolio's performance. They can also provide education on various investment concepts, answer your questions, and offer objective advice to help you make informed decisions. When choosing a financial advisor, it's essential to consider their qualifications, experience, fee structure, and investment philosophy. Look for advisors who hold relevant certifications, have a proven track record, and operate with transparency and integrity. Remember that investing involves risks and there are no guaranteed returns. However, by seeking professional advice, conducting thorough research, and making informed decisions, you can increase your chances of success and work towards achieving your financial aspirations. Section 9. Conclusion. Take the next step to secure your financial future. In conclusion, investing is an essential aspect of securing your financial future and building long-term wealth. By understanding the different investment avenues, their potential benefits and risks, and the importance of diversification, you can make informed decisions to grow your savings over time. Remember to start with a clear understanding of your financial goals, risk tolerance, and time horizon. Consider seeking professional advice from a qualified financial advisor to create a personalized investment plan tailored to your specific needs. Investing is a journey that requires patience, discipline, and a long-term perspective. By staying informed, making sound investment choices, and seeking guidance when needed, you can navigate the complexities of the financial markets and work towards achieving your financial aspirations. To learn more about unlocking smart investment strategies and take control of your financial future, click on the link below for a free video with valuable insights and actionable advice from our team of experienced financial advisors.